Get into the anomalies. Now, what is an anomaly? In this particular sense of efficient market hypothesis, market anomaly, it's that something which is sometimes markets are not efficient. What does that mean? It means it is possible to make extraordinary abnormal profits using either technical analysis or fundamental analysis, right? And this is a proven thing. There is considerable evidence that suggests that even though for the most part markets are efficient, but there are many situations in which there are efficiencies which we call anomalies. Now, what are those anomalies? We'll divide them across two major classes, which is time series and cross-sectional, and then within those we'll look at calendar, momentum, size and value, and then we'll have a look at some other ones as well. So let's get started with calendar. The first one, the January effect. And what really happens over here is that stocks go up in January almost always. So if you would just buy stocks in the beginning of January, there's a very, very high chance that you will make a decent return. Now, why does that happen? The reason is because in December, a lot of funds would sell their loss-making positions, and that loss would then help them save tax on their profitable positions of that year, which they've booked profit on. And then obviously they want to buy back those loss-making positions which they have sold because they're still waiting for them to go back up and make gains on them. So they buy them back in January. And then that's why in January you see stocks going up, and that anomaly has some reasoning behind it, and that is resulting in the January effect. There's also momentum and overreaction. Now, the underlying reason for this is behavioral psychology. Masses, people tend to get more optimistic than they should, and people tend to get more pessimistic than they should. So what happens is, let's say if this is the underlying trend for something which is justifiable, at times price goes too high and then price goes too low. So here there is euphoria, right? People are getting too excited about something and getting it overvalued, and that's what you see. The momentum creates overvaluation. And then of course there is pessimism as well, right? The doom and gloom situation when it comes down that, oh, it's never going to go back up. But that's also not true. So you have to sell to the optimist and buy from the pessimist, and you can do that and make extraordinary returns. And the reason for this anomaly will be something that we will study when we get to behavioral finance in just a few slides. But here we're talking about the anomaly that is a result of that behavioral finance and psychological issues of masses that are there. Right, now cross-sectional anomalies. These two, which is the size and value effect, they don't really exist anymore, right? What these anomalies say is that small companies tend to do better. Well, that's not really true anymore. Large companies tend to do better. But this was true at one point in time when it was discovered, where it was discovered that smaller companies have more room to grow, so they end up growing and catching up to the larger ones. But yeah, it doesn't really happen anymore. These days, the larger companies just keep becoming larger. And similarly, the value companies such as Exxon, if the market, for example, underprices them, and the growth companies, the market, let's say, overvalues them too much, right? So there is a certain reversal that we see, that Netflix went too high, then it came down a little bit, and Exxon went too low and it did come up a little bit. So from that perspective, yeah, the value effect did play out because Exxon fell too much and Netflix went too high. So it did come down a little bit and the value company did do better. But in the longer run, the value effect doesn't really hold either anymore. I mean, it used to, and that's what this theory is telling you, that the value for money eventually gives you longer return, longer return. But I mean, think about it, right? Because of climate change and everything, I mean, even though Exxon is a much bigger company today, it's highly likely that in future Netflix will be a bigger company than Exxon, because oil and gas is going to fade out and streaming is probably here to stay. So for the exam, what you need to know is that the size effect says smaller companies do better. Value effect says value for money companies have better return in the longer runs. But I think you should also know that these two effects are not really anomalies anymore. Right. Other anomalies and what are their implications? So closed-end funds, which the way they are formed is the fund manager would put the money together, buy the funds, and then the fund is closed. No new investment is possible. But these are tradable during market hours. The reason for that is the units trade on the stock exchange, right? So you can buy and sell them. But they're kind of locked in, and there are various reasons for which the unit actually trades a little bit lower than what it's worth, right? So you could technically buy them at a value which is cheaper than what it's actually worth, so that is one anomaly. Earnings surprise, well, it's not much of a surprise. What this is saying is, if a company is coming up with a positive earnings surprise, it is consistently earning more than what the market is expecting it to earn, then it does really well in terms of its stock price in the long run. Well, obviously, because if a company is doing better than expected, no wonder its stock's going to go up. So not much of a surprise here. This is interesting, IPOs. So we talked about investment banks and how they underwrite some issues where they're taking the responsibility that if nobody else will buy them, they will buy them, and they consciously try to keep the original price low, because then obviously there's a conflict of interest, right? On one side they're saying, okay, we will buy all of it if nobody else is buy it, so they do want to keep the price low, but at the same time their job is to try and get as high a price as possible for the issuer to get as much investment as possible. But of course they try and keep the price low, because otherwise they don't want to buy at a very high price if they're the ones ending up buying all of it. So what happens is that because they keep the prices low, when they list, the prices do tend to rise, usually on the first day. But then in the longer run, the performance is usually lower than what was being projected in the marketing and prospectus. So the price doesn't do very well in the long run. So you're probably better off subscribing in the IPO and then just selling it off on the first day. And then you have a very, very interesting anomaly. And this is something that says basically fundamental analysis, not just in terms of taking the future cash flows and calculating the present value and then seeing if market price is less, but also at a more higher level. So not just financial analysis in terms of accounting and numbers, but also at an economic level in terms of where the economy is, what's happening with interest rates, what's happening with inflation. And if you've got a good handle on all of this, you can actually make a lot of more money than what would otherwise be made by just buy and hold. And think about it, right? If you know where you are in the business cycle, so you can sell little bit before the stock market peaks, because the stock market peaks before the business cycle, and vice versa. Like, it's always a little bit ahead of the business cycle. So if you're really following the business cycle, before the business cycle peaks, you could sell your stocks. And then before the business cycle starts turning around, you could buy your stocks. And that would definitely make a higher return than buying and holding. So this is an anomaly, and that's why majority of the times, if you see on CNBC or Bloomberg or all of these stock market oriented news channels, that we're discussing where we are in the business cycle, what's going on with inflation, what's going on with interest rates, because this is something that has been proven to work in order to outperform the buy and hold, outperform the market. Right. So, is it easy to do? No. Is it possible? Yes. But sometimes a lot of these anomalies, they show up looking backwards, right? So for example, if this is the business cycle and you would say, oh, I would definitely, and let's say this is the stock market and dotted, you would say, oh, I would have definitely sold here and I would have definitely bought here. But when you are actually standing here, you don't know it's going to be a peak, because you don't know it's a peak until you're looking back and saying, oh, that was a peak, right? So it's easier said than done. And in practice, it's not really that simple to benefit from these anomalies. A lot of these anomalies we just notice because we analyze the data, and otherwise we wouldn't be able to see them in real time when they're happening. So that is one thing you should know as well. Now, I think this is really, really interesting, right? Behavioral finance. The reason why these inefficiencies are there. And think about it, right? What does the efficient market hypothesis say? The efficient market hypothesis basically says that, hey, everybody has all the information, number one. So markets, when we say markets are informationally efficient, that means everybody has all the information and everybody is rational enough to take the most economically optimum decisions based on that information. Well, I think that is far from the truth. Even though if we assume everybody has the same information because of search engines and everything, but do you think everyone has the same level of rationality to use that information to take decisions equally? I don't think so. And that's where behavioral finance comes in. There are a lot of limitations that people have psychologically, right? And it's not just that you're trying to predict individual behavior here. That's hard to predict. I mean, it's really hard to predict what one individual would do, but masses tend to be a lot more predictable because they display these biases in bulk, right? Starting with loss aversion. So what does loss aversion mean? Let me explain it to you very easily. Let's say this is happiness, right? And this is sadness. And let's say this is profit and this is loss, right? Now, if you get a profit, you get happy. That's good. But if you get a loss, even a little bit loss, I mean, the sadness is huge. So let's say this is like 100% sadness and this is like 50% happiness. To get 50% happiness, you had to get, let's say, a profit of 200%. But to get 100% sadness, even a loss of, let's say, 50% would be really, really sad for you, right? So what happens is we dislike losses more. They really make us sad. That's why what ends up happening is that people don't book the losses. What they do is when markets are going down, they actually don't sell their stocks or investments because they don't want to realize those losses psychologically in their mind, even though those losses have happened, but they just don't accept them because they're hoping that, oh, the market will turn around, right? But when the gains happen, they are very quick to book the profits. So it's like you have a garden and you have roses growing in that garden and you have weeds growing in that garden and you keep plucking out the roses and you let the weeds grow. Well, your garden is not going to be very nice, is it then? So what you have to do is you have to let your profits run and you have to cut your losses short. But we don't see that happening, right? So this is one of the biases that is there in the masses. Very, very difficult to manage psychologically to take that bitter pill and cut your losses short and then hold on to your gains and let them keep growing because you need that conviction that, yes, I have done my analysis and it is going to get to that intrinsic value. Right, I've bought it at a market price which is lower. I'm confident in my analysis. Just hold on to it. And yes, okay, maybe sometimes I'm wrong. So if it's not working out, well, you should have a stop loss. Sometimes you're right, sometimes you're wrong. The important thing is you have to be really getting a huge gain when you're right, and you have to have a small loss when you're wrong. So when you're right, you make a lot of money, and when you're wrong, you don't lose that much, right? But anyways, from an exam perspective, what you need to know about loss aversion is that investors dislike losses more than they feel happy from the gains. So because of that, they do irrational things. Right? It would be rational to let the roses grow and pull out the weeds, but they let the weeds grow and pull out the roses, which is completely irrational. They follow each other and they do that in information cascading as well. So let's say if I'm buying Bitcoin, right, based on some analysis, let's say I think Bitcoin will go up, which I'm not saying, but I'm just giving you an example, right? So let's say I'm buying Bitcoin because I've got some fantastic analysis, and then you're buying it because you believe in my analysis, and somebody else is buying it because they believe in your analysis. So, I mean, this is also an example of herd behavior where we're just following each other, but here, at least, the first person who's buying it is not basing their decision on just something completely for no good reason. They are buying it for some solid reason. And then, okay, others are blindly following them, but at least the original person has a good reason for buying whatever they're buying. And the information is cascading that way. In herding, the original one doesn't even know why they're buying it. They're all just buying it one after the other. So that's irrational, right? Overconfidence, and this is something you can also link to another bias called gambler's fallacy. Even though they are different, but they are related in a way, and I'll just first explain gambler's fallacy and it will help you understand overconfidence. So see, gambler's fallacy is, think about it, you walk into a casino, you make your first bet and you win. You're going to be feeling like on cloud 9, you're probably going to feel invincible that I can never lose, and you're going to probably bet a lot more on the next bet and you're going to end up losing, right? So the same thing happens in the financial markets is that once you make a lot of money, maybe you have beginner's luck, but then you feel like, oh, I'm going to be right all the time. Well, you're not going to be. You just got lucky. And that creates a sense of overconfidence. Now, overconfidence is a separate bias, but it's linked that basically people put too much confidence in their ability and they take decisions which are not rational. They don't take into account, what is the current situation and what is the fact or what are the facts of the current situation. Which also kind of links in with this representative bias that they are basically giving a lot of importance to prior experiences and not taking into account, okay, what is the current situation, right? They are thinking on facts based on events seen before. Also, a linked concept is conservatism, that they don't really take new information. Right, they're sticking to their old perspectives. They're being conservative. They're not considering new information. So yeah, narrow framing is thinking in a very small sort of a frame of mind, not looking at the bigger picture. Mental accounting is a very interesting one. So let's say I might have money in an account which I just don't want to touch because I say no, this is my saving, and then I have another account which is for investment, and I say no, this is saving, this is investment, and I'm not going to mix them, which is a little bit silly because money is money, right? And they're both, it's fungible, but this is what people do, that they put it in different buckets and then they treat it differently, which is, to be honest, not really a bad thing. Sometimes it really helps you. And what you will learn as you get through level 2 and level 3 as well is that if your client is exhibiting some of these biases, what you will learn is that biases are emotional and cognitive in nature, right? So cognitive means that they are doing some irrational behavior because they are thinking about something the wrong way, or their data is wrong, or they're processing information in a wrong way, but that's fixable easily, right? You can teach them how to think about it in the right way, how to analyze the information available correctly. But there are certain biases which are emotional, which are hard to fix. And as their investment manager, what you should do is try to accommodate their emotional biases, right? I mean, if they think in a certain way, try to accommodate instead of trying to force them to change, because emotional biases are really hard to change. Anyways, yeah, so I mean, this is stuff that, affects us all. And what you could do is sell to the optimist and buy from the pessimist and make some extraordinary amount of money, because markets show irrational behavior. All right, so what is the link between behavioral finance and efficient markets? For the exam, what you need to know is that it's possible for behavioral biases to cancel out each other, and if they do, then markets would be efficient. It's a kind of a silly thing to say, but that's what it is, right? What they're saying is that markets can be considered efficient if the biases cancel out each other, right? But if the biases don't cancel out each other, then the markets will not be efficient. So do the biases really cancel out each other? I don't think so. But theoretically, if they would, then the markets would be efficient and there wouldn't be any irrationality and everybody would be rational. Because some people are irrational this way, some people are irrational that way, and if that cancels out, then the average is that people are rational, which I don't think is true. But yeah, this is what this theory says. All right, guys, very interesting learning module. Let's wrap it up with a summary. What we said is that the price should reflect all available information, and any new information should quickly reflect into the price, and therefore it should not be possible to make abnormal returns in an efficient market, right? Only the price should be expected to move for if there's unexpected information coming in. Right, and what is an efficient market? It is where the market value is equal to the intrinsic value. And if that intrinsic value is calculated based on just public information, then it's a semi-strong. If it's even incorporating private information, then that's strong. But that never really happens. And what are the factors that affect a market's efficiency? Of course, you want a high level of participants. Few participants could manipulate the market, so we want a high level of participants. Everybody should have all the information. Companies should disclose information properly. There should be no or very limited limits to trading, so free market. Transactions cost should be low, information acquisition cost should be low as well, so everybody is able to efficiently trade. So that makes the market, when we say market efficiency, that's operational efficiency, right? So operational efficiency is related to the transaction cost, and informationally efficient, which obviously relates to all of this information and pricing of the information into the market price. So if you have a weak form, the market data is priced in, so you can't use technical analysis. If you have a semi-strong, even the public information is priced in. You can't use fundamental analysis to make extraordinary returns. And if it were the case that even private information was priced in, you couldn't use private information to make extraordinary return. But well, that doesn't happen, because then it would be illegal if somebody is using private information to change the market price and bring it to its intrinsic value, which is incorporating private information also. That is illegal. Right, so weak form, semi-strong form, strong form. Technical analysts help keep the market weak form efficient. Fundamental analysts help keep the market semi-strong form efficient. And government regulation stops the market from becoming strong form efficient. Anomalies, time series, January effect, momentum and overreaction, and then cross-sectional you have size and value. Doesn't really happen anymore. January effect, we still see it, because I mean there's a very good reason for that, right? The tax. And the momentum and overreaction, because people are just loss avert, right? So doom and gloom, and it's just that people are emotional. So you have optimism and pessimism, and then there's euphoria here, and then there's doom and gloom here. So you have to buy from the optimist and sell to the pessimist. Size and value effect, not really happening anymore, but you need to know it for the exam, that what this theory says, that smaller companies tend to do well and value stocks tend to do well. The reality is, however, what we are seeing now is that larger companies are doing well and growth companies are doing well. Other anomalies, closed-end funds trade at a discount to their NAV. Earnings surprise, so if a company is doing well, surprising everybody positively with their growth, their stocks tend to do well, no surprise there. IPOs, this we understand that the investment bank consciously tries to keep the price low, and then obviously it goes high on the first day, but then tries to then eventually underperforms. And there's a reason for that as well, that, you know, they sell it looking like the best company in the world in terms of the prospectus and future projections, but the reality is that it doesn't really do that well. So eventually the price doesn't keep performing, and actually it comes down. And of course, this is my personal favorite, that if you really know what's going on in terms of inflation and interest rates, and you're really able to time the business cycle, then you can actually make more money than just buy and hold, right? That's why on Bloomberg and CNBC, you'll see all the time they're talking about what's going on with inflation, what's going on with the interest rate, and what's the Fed expected to do. And then you've got your behavioral finance, biases, loss aversion. Talked about this in detail. I drew a very nice graph for you with respect to happiness and sadness and profit and loss, and that the utility from happiness is there, but it's not that much compared to the fall in utility with a little bit loss, right? So people are avert to losses. They don't like losses. Herding, we just follow each other blindly with basically no good reason, right? At least in information cascade, the first person has a decent reason to do what he's doing, and then everybody else follows them blindly. So that is still irrational. Overconfidence, again, thinking that you're invincible. Representativeness, using some past experience to think that it will happen in the future, and all three of these are linked, right? Conservatism, failing to incorporate new information, sticking to your mindset or your previously believed concept. So again, we have to be open, we have to be open-minded, we have to take the facts of the matter into account, right? Facts change, so whatever is the current situation, you have to take that current situation into account as possible and try and think big picture as much as possible. So don't do narrow framing. And mental accounting is, money is fungible, right? So just because it's in a different account doesn't mean that it's something that is not usable. Money is money, and you should think about it like that, ideally, if possible.